All right, guys, I'll make you a deal. Heads, I win. Tails, I don't lose much. Sound different than what you're used to? Well, this phrase is the key to something called Dhando Investing, coined by a guy named Mohnish Pabrai. Haven't heard of him? Maybe you've heard of Warren Buffett. This is how they invest. Heads, I win. But if it was tails, I wouldn't lose much. How does this method of investing work that these guys have made tons of money? We'll talk about it in this video. Hey guys, my name is Michael Thompson. On this channel, we discuss personal and professional development from a Christian perspective. And as a Christian, it's important that we steward our finances well. We're not just supposed to be really wealthy and rich, that's not bad, but we're supposed to be givers. And so that may mean that you are wealthy and rich. Being wealthy and rich is not the point, but how you manage the money that God has given you, that's how we're supposed to really focus as Christians to be good stewards. Now, this book, The Dhando Investor by Mohnish Pabrai, as I mentioned, he had a philosophy very similar to Warren Buffett. These men, they took on investments that had a significant upside and a minimal downside. You say, okay, well that's obvious, right? If you're gonna make money, then you should invest in things that have a significant upside. Yes, but a lot of people invest in things like really volatile stocks, and they do so in a proportion that is not a wise investment. And so the money that they put into the stock, they could have a significant upside. But if you can also lose all the money, there's a significant downside, not qualifying that investment as a Dhando investment. Heads, I win, significant upside. Yeah, with the stock, there's a significant upside, but tails, in a Dhando investment, I don't lose much. There is a potential that you lose all the money in a volatile stock. But an investment that would qualify as a Dhando investment would be like what the Patel family did moving to the US. Now, that's a main focus of the book. The central principle teaches that this Patel family, that uses them as an example, they took on investments like hotels, and with that hotel investment, they were able to take care of a lot of their personal finance expenses through the vehicle that was also their business. Meaning that even if the hotel didn't book up, they were still able to cut a lot of personal expenses through the investment. So Pabrai, he draws on examples, like I said, from the Patel family, but he also shows people who own gas stations and how they use that investment to make money, but it wasn't necessarily something that if it went poorly, if it went tails, they didn't necessarily lose a lot on their investment. So in this video, we're gonna discuss a few key principles of Dhando investing. Here's the first one: invest in existing businesses. Now, I noticed when I read this book that it was a little different than other books that I've read by guys like Robert Kiyosaki. You know, he wrote Rich Dad, Poor Dad, and he also wrote a book called Rich Dad's Guide to Investing. And he talks a lot about building an asset from scratch that is worth a lot of money. He says that's how you should make a living. That's how you should make wise investments. But Mohnish Pabrai says that you should invest in existing businesses because these businesses have a track record, and you can look at the history of the business and see, here's where I can capitalize that the business didn't do well. Here's something I can improve that would give me a guaranteed profit in the future. You say, which one is it? Well, that's the funny thing about money. Either one. Because anybody who knows how money works knows that there's lots of different ways to make money. There's lots of different ways to be a skilled investor. And he talks about the benefits of an existing business, but we all know that if you start a business from scratch, there's a lot of profit to be made there as well. Another example that Pabrai gives in his book is the difference between investing in Coca-Cola versus an IPO. Now, an IPO is an initial public offering. This is where a company that is private goes public and then gives different people out in the public an opportunity to put money and to buy stock into this company, or part ownership. That's what a stock is. Now, Coca-Cola is a company that's been around for a long time and has an established track record. You can look at the Coca-Cola stock and you can see what the past history is. You can see in a good year what it'll do, and in a bad year what it'll do. So there is a history. It's an existing business. But an IPO, this is something that, as soon as the company comes out, you can purchase stock for different prices, but it can be very volatile. You can make money both ways, but the Dhando way of investing is invest in something that already exists. The third key principle to Dhando investing is to invest in distressed businesses or industries in times of trouble, because it means there are bargain prices. If you're familiar with American Express, you know it's been around for a long time. And at one point there was a salad oil scandal. You can look up the details if you want to know how it all worked out. But this caused the stock price to go down. Now, when the stock price goes down, remember, when you think stock, you should think part ownership in a business. When that stock goes down, if it's a good company and it's run by strong management and it has a durable competitive advantage, if you read about Charlie Munger, if you don't, go look it up, it's important. A durable competitive advantage means that the company can do something that it's very difficult for other companies to do. It's not that they can't do it, but it's hard for them to get to that point. So a lot of people know American Express, the name, it's a household name. But when that scandal happens, the price goes down in the stock. If it's a good company, you should be thinking, man, this is on sale. And buy some of it. Buy some ownership at a bargain price. Because you know that whenever the stock price goes down, if it's a good company, you're really getting it half off or whatever percentage off that as far as it is down. Instead of seeing the market and seeing something go down and being like, oh boy, I'm losing all my money. Well, if you know how the stock market works, if it's a business that's gonna do well, it's gonna come back. And a lot of people, they invest with their emotions, and if you've ever invested and lost money, you know why. It's hard to see your money go down. But if you see money go down, if it's a good company, then that's an opportunity. And that's what the third point is. Distressed businesses, it's an opportunity to buy into the company. It's not necessarily a bad thing. The fourth key principle, I mentioned this a little bit earlier, is invest in businesses with durable moats or a durable competitive advantage. One of those advantages is brand loyalty. If you think about Nike, I mentioned Apple earlier. Some of these brands, you think about that brand and you know a lot of people, they will only buy that brand. When I was a kid growing up, Nike and Under Armour, they were household names. Anytime I saw a professional athlete, the sponsors would pay them to wear the clothes. But athletes maybe with Nike wanted to wear it anyways, but in general, if you don't necessarily understand sponsorships, you may not know that the athlete could be indifferent about wearing that brand. But that brand is smart because if they put the brand on a main athlete, then all the kids watch them and they want that brand. Even if the brand is lower quality, there's a durable competitive advantage, which is the brand loyalty. Walmart, their durable competitive advantage usually isn't brand loyalty. I mean, some people even go there to sightsee, okay? It's not that you want to buy something because it's got, the little yellow circle logo that's Walmart, but their competitive advantage is their low cost on their goods sold. If you think about Amazon delivers with a delivery service that is unparalleled. So a business with a durable competitive advantage is very important. And it's also a tongue twister if you want to keep working on that, okay? But invest in a business that somebody else couldn't just come along and do what they're doing easily. It's not that it's impossible, but it wouldn't be easy. That's the fourth principle of Dhando investing. The fifth principle of Dhando investing is to invest in a business with low risk but high uncertainty. Not high risk. You want to stay away from high risk investments. If you listen to Warren Buffett's theory on investing, he says rule number one is don't lose money. And he said the second rule is basically don't forget the first rule, don't lose money, okay? You don't want to be investing in something that's a very high risk. You don't want to be able to lose your money. You say, how is that possible? Well, when you do your homework and you understand how a business ticks, this is possible to invest and not to lose money over the long term. That's the other key. The stock market does go up and down, but if you make a wise investment, you may not know if you're going to make money in 1 year or 2 years. But if you invest in a company like John Deere, for example, if they have a durable competitive advantage, they have strong management, and you know that the population in the US is going up over a long period of time, you know that that's probably a pretty safe investment. That company's probably going to do well over time. So low risk, high uncertainty. That's what you want to shoot for. Another thing that can happen is like a lawsuit, like I mentioned earlier, that makes the headlines, can make the stock price depreciate. Or if you have like a CEO that got fired, but the company over a period of time has had several CEOs and you realize they are probably still going to do well, that's a low risk. The company's not going anywhere, but high uncertainty, something happened recently making the price go down. So that's what you want to focus on. That's the fifth principle. The sixth principle is invest in a business with a margin of safety. You want the business to be able to do poorly 1 year because that's life, and you still make your money back over the long term. If the stock doesn't perform as well as you thought next year, you don't want that to mean that you lost all your money, okay? You want to pick a stock that can not necessarily, remember when I say stock, part ownership of a business that could not perform at its best, but you're still gonna make money. Basically, the investment is still good if it doesn't perform like you thought or if it doesn't perform at its best. So that's the sixth principle. The seventh principle is a strong cash flow. You want a business that has a lot of cash coming in and proportion especially to their expenses. So a cash flow, it's the movement of money in and out of a business. And this means that you want a business that is constantly bringing in cash. You say, that's obvious. Well, yeah, but if you invest in certain businesses, there's not a high cash flow. And you wouldn't know that unless you knew what the term was. So another way that you can look at cash flow is based on your household. You know, how much cash comes in and how much goes out and what's the difference. And whenever you know that of a business, you can tell how healthy the business is and if it's one that's worth investing in. The eighth principle of Dhando investing is to focus on arbitrage opportunities. This means that you're looking for a mispricing in the market. Now, this does go contrary to the way that some institutions teach about the stock market. There's something out there called efficient market theory, and this theory says that stocks fully reflect all available information at any given point, and that stocks are only ever priced at their real value. So this means that a stock, it's not possible for it to be priced less than what it's worth. And that really changes the landscape. And it's funny because guys like Warren Buffett, they have proved that this theory is not correct over a long period of time of them investing and beating the market. You say that's a bunch of technical jargon. Well, here's what it means. When you invest in a stock, there are times where people sell the stock because something happened and they get really worried and the stock is actually priced less than what it's worth. Meaning you can buy a $10 bill for $7. If you had that opportunity, man, buy as many as you can. And that's the Dhando way. Look for pricings of stocks that are not accurate. And like I said, a lot of times that happens because people, they're emotional investors, and when something happens in the market, it can disrupt everything, and that gives you a great opportunity to buy something at less than what it's really worth. Well then, if you're gonna do that, you have to know what the stock is actually worth. And that's where it's important to understand how a business works, understand the different qualities of what's good management, what's bad management, what's a good cash flow, bad cash flow, you know, what does the company own in terms of assets, all these different things. When you understand that, you can price a company effectively, then you know when it's mispriced. And you can buy a $10 bill for $7. If it's discouraging, you're like, I don't know all this stuff, maybe you want to invest in somebody else, or you want to invest with one who actually knows what all these terms are, that's great, but you can also learn them yourself and then save thousands and thousands of dollars when it comes to investing. But I'm not your personal investment advisor. Don't listen to me. At least I think that's what we're supposed to say on these videos, okay? The ninth tip is be patient and bet big when the odds are in your favor. Pabrai emphasizes this concentration that when you find a great opportunity, don't just dabble, but commit all in. Like not 100% of your portfolio, but if you know what a stock's worth and then there's a certain depression, then like what Buffett did in 2008, you can really go all in when these stocks are lower because you know the American economy is going to move forward. Maybe not right away, but you know that a stock is not priced correctly, so man, you can go all in. You can go 10% of your portfolio in, okay? I'm not saying put 100% in, but obviously be wise with the amount. But you wanna be able to be building up capital, be building up your cash on the side, and then when an opportunity comes up, you can capitalize on that. The 10th tip to Dhando investing is to think like a business owner and not a stock trader. A stock trader is one who, well, maybe they're like a day trader. They'll look at what does the stock do at 9 a.m. and they'll try to get in at the beginning of the market opening and then get out whenever it's up. You don't want to think that way. If you're going to be like Buffett and some of the guys who have invested in the long term, done really well, then you're going to buy stocks because of information about the business. You're going to know about the competitors. You're going to know if they have a moat, you know, a competitive advantage. You're going to know about the management of the company, and you're going to know about the potential future things that could impact whether the business does well or not. If you know those things, then man, when that stock is undervalued, you can go in at a large portion. And these guys also say, instead of paying someone else to do your investing, you can invest on your own. If you find 10 companies that you have used their products and that you know the numbers behind, you know the management of those companies, you can invest in those 10, and over the long haul, you can know that there's very little risk because they're good companies and they're companies that you've used their products. You know that in the future, it's highly likely that they'll do well. Will they all do well? Probably not. But if there are 10 of them, then often the good ones will make up for the bad ones. So a bad way of thinking and not thinking like a business owner is like buying stocks because somebody at work said that the stocks were up. And it's somebody who doesn't understand business and doesn't understand the way that businesses and cash flows work. So think through those things. If you're gonna be a Dhando investor, you can beat the market. Again, I'm not your advisor, so don't do anything that I say. Just, log it in the back. And if you do it, don't do it because I said that you should do it. But if you want to know a lot more about these guys, man, guys, go read Dhando Investor by Mohnish Pabrai. Read Rule 1 Investing by Phil Town. Think through the way that these guys invest. and start building your own portfolio of companies that you're studying. That way, whenever the market goes down, you can get in these companies and you can get in with a larger percentage of your personal capital. And that way, long term, you're going to be able to see that you're able to invest with a really low risk and a very significant upside. That's the Dhando way. Heads, I win. Tails, I don't lose much. Hey guys, I hope you enjoyed this video. Mohnish Pabrai, he's very similar to Warren Buffett in the way that he invests. He says, pick simple things, don't pick complex things. One of the phrases he uses in his book is that pick a company that could be run by an idiot because one day it probably will. So pick a company that can for sure make money even if it has bad management and it has a durable competitive advantage and it's priced fairly. And that's the company you want to watch it. That way when they have a lawsuit or a scandal, the price goes way down, you buy in, and then it's a very low risk, very high upside investment. Well guys, if you want to know more about these guys, go read their books. I can summarize a few things in a video, but hopefully I just whetted your appetite and you can go read Mohnish Pabrai, go read Phil Town, go read Warren Buffett, Charlie Munger, all the legends. Hope you enjoyed this video. We talk about personal and professional development here. Finances is part of that. And one of the ways that you can really set yourself up well to handle your finances is by managing your time well. So go watch this video on time management and we'll see you guys in the next one.